Hey everyone, this is Purti, and in this video let's talk about call options. In my previous video I talked about what are call options and how to buy a call option. Today let's look into how options are priced and how call options prices increase with increase in the stock price. In my previous video I mentioned the variables required in an option contract. Number 1 is the strike price, number 2 is the expiry, and number 3 is the option premium. To exercise or execute the option contract, certain conditions have to be met in a call option and is applicable if you buy a call option. The first condition is that the stock price has to be greater than the strike price, and the second condition is that the time must have expired, that is the last day of the contract. If you leave your contract after buying it and just let it expire, the contract is automatically executed if these two conditions are met. Else the contract expires worthless with the risk of losing your entire option premium. Let's dive deeper into the pricing of the option. Mind you that it might just get a little bit technical, so sit back, relax and try to take it all in. I will dive deeper from a conceptual point of view. There are three aspects to understand the pricing of options. They are the delta, the theta and the gamma. Let's look at the first aspect of the delta. Let's assume Tesla is trading at $662 today. Let's say you think Tesla is going to hit $1,000 in the next 30 days. And you want to take advantage of this move without actually buying the stock. So the only way you can buy this is through options. So you buy a call option with a strike price of $1,000 with a 30-day expiry at say $10 a contract, which translates to 10 times 100, that is $1,000 initial investment. It's pretty cheap, but let's just go with it. Let's say now 5 days have passed and Tesla has gone up to $750. Would your option be worth more or less? You can pause the video here and think about the answer yourself, else let's just continue with it. The answer is your option will be worth much more than $1,000 because there is a higher probability that the first condition I mentioned is met, that is, with respect to the stock price being greater than the strike price. That is, $750 minus $662 is $88, or in other words, the chance that the stock will be at least 1,000 at expiry is increased as the current stock price has increased to $750 as compared to $662 5 days ago. That is why your option is worth much more and is more valuable. Similarly, if the stock went down to say $550 from the $662 after 5 days of purchase, the probability of the stock price being greater than or equal to the strike price reduces, and hence the option price reduces. The term chance is known as delta, which is nothing but the probability that the stock price is greater than the strike price as of today. Now, let's look into the second aspect of option pricing, which is the time of expiry. If you buy any option with a 30-day expiry, the number of days left to expiry always decreases as time progresses. On the last day of expiry, the number of days left becomes 0. So whenever you buy an option, be it a call or a put, the time always decreases. So just like in the previously discussed Tesla case, imagine we bought the 1,000 strike price call option. From a purely time perspective, let's say 5 days have passed and the stock has not yet reached $1,000. So the option is left with only 25 days for the stock to reach $1,000. This causes the option to become less valuable as of now, as the time available is less. So the probability that the stock price is above the strike price always decreases, because there is less and less time each day as each day passes for the first condition to be met, to kind of execute the contract. If the expiry was 6 months, there would have been more time and hence a greater probability compared to the 3 months expiry for the first condition to be met. This time factor reduces slowly initially, but it decays exponentially as it reaches the expiry. This is also known as theta. Let's look at a few graphs to understand this better. Notice the gap between the purple and the blue lines. The purple line indicates the option premium as of today, and the blue line indicates the option premium as of the expiry date. The gap between the two lines indicates the theta value. As and when time progresses, the purple line converges to the blue line. Let me show you how theta decays with time. If you notice on top, I have changed the settings to reflect multiple lines from today till the expiry date. If you look at the colored index I've circled on the left, there are dates ranging from today, that is the April 3rd, April 22nd, 11th May, etc., till the expiry, that is the 18th June. Notice the first 2-3 lines are very close and the option premium is mostly contributed by delta. Hence, if the stock is at $1,055, the probability that the stock will remain above the strike price of $1,000 is very high, and hence the options are more valuable. As we hit the May 30th line, the line starts curving more and more, and this is the theta decay, and it increases exponentially as it approaches the expiry. The option premium is taken over by theta, and hence we see that the option premium is reducing if the stock is still at $1,055 at expiry, because theta decays exponentially near expiry. To explain the third aspect affecting the option pricing, you need to have a little bit of imagination. While I don't expect you to understand this immediately, please ask questions in the comment section below. So when you buy a stock now, there is no expiry or strike price concept for the stock. However, if you buy an option, for example a call, you are getting the right to purchase the stock at a predetermined price, that is the strike price, that is in the future. Say for 30-day expiry option, you are purchasing the right to buy the stock in 30 days. Now in the next 30 days, say the stock has earnings report and the market expects a dramatic change in the stock price via a catalyst, then this factor should also be taken into account today when pricing the option. In other words, the expected volatility of the stock in the next 30 days is inbuilt in the option pricing. This is known as the Vega factor of the options. As an example, if Tesla has earnings tomorrow, a $10 difference in the strike price and the stock price can cost you up to say $8 a call option, but on a normal trading day, this very same option would cost you around $5 to $6. Technically speaking, the Vega factor of the option pricing is the amount that an option's contract price changes in reaction to a 1% change in the implied volatility of the stock. So, to sum up, delta, theta and Vega together determine the option pricing. This mathematical equation for option pricing is called the Black-Scholes model. We don't need to know the equation for the Black-Scholes model, but just how it works. I will get into more details for each of these variables in a later video. So that wraps up this video on call options and the option pricing. Let me know what you think of this video and post your questions and comments below. And keep in mind that this video is for information purposes only and should not be interpreted as any financial advice. If you like this video, don't forget to like, share and subscribe and hit the bell icon for more videos on financial literacy. Thanks for joining me today, and I'll see you all in my next video. Bye-bye.